Welcome, everyone, to Your Money Matters. I am Angela Giroux, your host and publisher of the Bauman Letter. Now, speaking of the Bauman Letter, Ted, I wanted to congratulate you very quickly on a job well done, especially with your endless income model portfolio as part of the Bauman Letter. I was just nosing around, and you have a 100% win rate right now, which is pretty incredible given the circumstances. So congratulations. You've got positions in there up as much as 67% in 10 months, 52% of the past year. And again, these are boring dividend plays. So well done. It's a great reminder how important it is to stay diversified. You never know what's going to happen. And it's an important reminder to have somebody in your corner that knows what they're doing. So for those of you watching, if you want to take a peek at this model portfolio and the other two, please click the link above and below for a risk-free membership to the Bauman Letter. Now, fellas, I am going to shake things up today. I hope you're ready because I have a chart.
You have a chart.
You get a chart now?
Yeah, wow.
I have a chart. I was feeling very left out.
Okay.
Warning, it's not up to date and it's blurry. It's not pretty, but it's a chart. So I'm bringing it up. And I just wanted to note the size of the financial sector in the United States and how it's grown over time. I mean, it's really incredible. This only goes up to 2009, but the trend continues. It's now nearly 10% of total US GDP, which is just incredible. Obviously, that raises some red flags, some dangers, but right now, what I want to focus on is this financial sector sucking up stimulus money that could be going to better uses. It's so huge. I mean, it's encompassing everything now. So Clint, I'm going to start with you and get your thoughts on it.
Yes, I mean, the chart you just showed right there, the bank stock prices have certainly been reflecting those good fortunes lately. And I think it really comes down to three factors that have been driving earnings. And, stimulus and everything else that's going on in the backdrop might have something to do with it. But I thought it'd be first good to highlight sort of the two or three things that are really driving earnings right now. But first, let's just take a look at a handful of bank stocks right here, just to show you what I mean with the stock prices. This is over the last 6 months or so. We got the S&P 500 is a blue line on here, up a little over 20% for the last 6 months. But then, you can see we've got Goldman Sachs on here, the red line, Bank of America, the green line, Morgan Stanley's the orange line, and JP Morgan in purple on here. And all these stocks up anywhere from about 45% or so, upwards of about 65%. Over that same time frame. Once again, I think a lot of it just has to do with these stock prices catching up to how well earnings have been. So just even in this most recent quarter, you look at, just read off a few numbers here. JP Morgan put up $4.59 a share versus $3.10 was expected. Goldman Sachs put up $18.60 a share versus $10.22 that was expected. So earnings have been just absolutely ripping higher. And really, I think it comes down to three key things. One's the yield curve. The yield curve environment has been great for banks here recently. We've talked about how higher yields have, at least a couple months ago, started to torpedo tech and growth shares. Well, that's been steepening the yield curve. And so banks, that's a good environment for them because they borrow short and they lend long. And so they collect the spread between the two. And that rate, I mean, even if you look at the 10-year treasury to 2-year treasury, that stands at 1.4% right now. That's the highest it's been in about 6 years. So you have that positive backdrop for banks, but then there's really two other critical factors at play here. One is capital markets activity. So that's areas where banks are trading stocks or they're trading bonds on behalf of their clients. They collect a fee for that, or maybe they're helping companies raise money through IPOs or through debt issuances. Merger and acquisition activity, that all gets captured in that capital markets divisions. And just to read a couple numbers here real quick, I mean, Goldman Sachs, their trading revenue was up 47% compared to last year. Morgan Stanley, their investment banking fees were up 128% compared to last year. JP Morgan's investment banking division, their fees were up about 222%. So these capital markets divisions have been just absolutely on fire. They've stayed on fire this year so far. But then the last really big factor that's been boosting earnings here is something called loan loss reserve. So when a bank expects to take a hit on a loan that it's made, it has to set aside some capital to be able to cover that loss. And when the pandemic hit last year, banks had to set aside a lot of money on expected defaults that they thought were going to materialize, but those never ended up happening through the various government programs and stimulus. We've been able to hold off that wave of defaults, but that means that money set aside can be released from those reserves. And when they do so, that money flows through the income statement and becomes earnings based on how the accounting works. And just the four largest banks have brought $13.3 billion back from loan loss reserves just in the most recent quarter. And so it's the confluence of those three factors really driving profits right here.
All right. And Ted, I really want to look more specifically at the stimulus, if we could, and the impact that it's had.
Yeah. Well, just to frame it, I mean, just to think about the way that the financial sector relates to the economy and why it's problematic when it becomes so big. If you think of the economy as a circle, where people spend money on businesses, businesses spend money on people. They buy capital, they buy labor, whatever. It's a circle, and the more money is in that circle, and the faster it's going, the more income everybody has, and the higher GDP rises. The financial sector is kind of like a little whirlpool on the side that can take some of that money out of that circle and then kind of recycle it through just financial trading, all that kind of stuff. But if it's stuck in there, it's not available to stimulate the real economy. And I'm going to show you how so much of our stimulus money has actually got stuck in the financial sector whirlpool and why that's a problem. So let's start with just the impact of stimulus. I mean, Clint has showed that stimulus, both the Fed and the government spending money, has had a huge impact on the bank's fortunes. You would have thought that they would take the biggest hit from COVID, but they're actually the big winners. They're bigger winners than Main Street by the longest shot anybody can imagine. It's not just good for banks, though. It's also good for the bond market, corporate bonds, which again, banks make money trading corporate bonds. You got an excess supply of money, which I'm going to show you just now. But if you can imagine this, the junk bond market, that firms that are like rated below, I think, triple B plus, have sold $157 billion worth of new debt in this quarter so far, this year so far, which is the most ever. Leverage loan markets, which is even more dangerous, which is basically variable interest rate loans to low quality corporate buyers, $172 billion so far this year. Here's a chart that shows the performance going back to before the great financial crisis. On the right-hand side, you can see that is the leveraged part of the market. So money is flowing into very, very risky lending at an enormous clip. So that's the one thing to look at. But paradoxically, for the banks themselves, it's not a good time to be in the lending business, because the people who can't get corporate bonds, in other words, all the small and mid-level companies that can't issue bonds because they're not big enough and they're not rated, they're not borrowing money because the economy still hasn't recovered for them. So here's a chart that shows that the amount of money being pumped into the economy through stimulus has risen far away from the amount of bank lending that's actually happening. In fact, bank lending has pulled back in 2021. So the paradox is it's really easy to borrow money through corporate debt markets, through bonds, but not through banks. And so the banks are stuck with all this money that's sitting in there. Now remember, deposits of cash for banks are liabilities on their balance sheet. They're something that they owe to people. And according to the Federal Reserve rules, you have to maintain reserves against those liabilities. So the problem is that the four biggest US banks have taken in almost $1 trillion worth of additional deposits just in the last year. Well, basically during 2020 up till now, $1 trillion of money that's just sitting on banks' balance sheets as liabilities for them, but obviously as the deposits of mainly corporations. So corporations are not spending money, they're not borrowing money. Now here's a chart that shows the rate of increase of deposits in commercial banks. Go back to 2020, look at that huge jump. A lot of that is companies just deciding they're not going to invest. Not going to invest because we don't know what's going to happen. We're just going to put our money in the bank and hope that things get better. And they're still doing it, right? So here's another chart that shows the bank loans as a percentage of total deposits. And this is just for major banks, national banks. It's down to the lowest it's been since the mid-90s. It's at 61%. And what that means is that banks have far more cash than they can use, and people don't want to borrow it. Now, the problem here is that, in terms of the Federal Reserve System, banks have to increase their reserves in order to, match the liabilities that they have. So lots of money coming in from stimulus. A lot of it is coming in from the transfer of reserves over onto the positive side, but it's also coming from people paying off credit cards, paying off mortgages with stimulus. So all this money that the federal government pumped out, a lot of it is actually ending up in bank deposits, and the banks have to do something with it. So here's a chart that shows right now the total reserves of financial institutions at the Fed, and look at that big spike in 2020. So they're having to park off more and more and more money at the Fed, really in order to match the rate of growth of their deposit accounts. Now, here's the paradox. In order for that to lessen, because banks don't want that. They don't want to have huge liabilities in the form of lots of deposits and they can't make loans. So here's what they're going to do. Paradoxically, they're going to borrow money themselves. They're going to issue new debt so they can change their actual debt to equity ratio so they can reduce those reserves. So that's the one thing they're going to do. The second thing they're going to do is they're going to pay out dividends. They might even issue extraordinary dividends this year. Third thing they'll do is they'll buy back shares, which is going to push up their share price. But the key thing is that if you can imagine a little series of arrows, it kind of works like this. You got stimulus, then you've got the economy, then you've got the banks, then you've got bank shareholders. And that's where a lot of this stimulus money is ending up, because the financial sector is so dominant in our economy, because debt is such an important part of the business cycle and the business system in the United States. The paradox is that little whirlpool on the side of the real economy is sucking out a lot of the money that's intended to boost economic growth. So, back in the great financial crisis, a really great writer for Rolling Stone said that Goldman Sachs was a giant vampire squid relentlessly jamming its blood funnel into anything that smells like money. And essentially the idea was that whenever there's a crisis, no matter what happens, somehow Wall Street manages to get the best deal of everyone. And it's happening again. So if you look at, the drainage, at some point is going to calculate what percentage of stimulus spending has actually been drained out through the financial system and is going to enrich bank shareholders and executives, and it's not going to be pretty.
They're getting a bailout again, and they don't even need one this time. It's incredible.
It's the default condition. I mean, our entire financial system is set up on the basis of government support through the Fed, and now basically through support for bond markets, and also indirectly through federal stimulus to Main Street. And it all ends up with the banks, not all of it, but so much of it ends up with the banks that could be doing other things.
Well, thank you for that extremely enlightening, if somewhat depressing explanation.
It can be changed. None of this is written. This is not a free market. Hey? This is the result of specific decisions, rules, and institutional arrangements, and specific favoritism that goes on. I mean, like the carried interest rule. All those kinds of things, these all contribute to that. Those are all political decisions. It could be changed if you wanted to.
Well, that again leads me to the Bauman letter. For those of you watching, it's important to stay diversified. It's important to have somebody in your corner that knows what they're doing. And that's why it is a great time for you to see all of our offerings. Thank you, Ted. Thank you, Clint. I'll see you again next week.
Thank you.